Good evening, ladies and gentlemen, and welcome to tonight's class on day trading strategies and how to be a day trader. Tonight's class is sponsored by Alvexo, one of the world's leading CFD and Forex providers. Alvexo is regulated throughout numerous locations around the globe, so you know when you're trading with Alvexo, you're trading with a legally recognized, regulated provider who offers outstanding trading. You can use their online web trader. All you have to do is put in a username and password, and you'll get real-time quotes, one-click trading, all types of order executions, and high-speed execution, and incredibly great security. So you know you can trade with confidence. Or if you want the more advanced platform, you can download the Alvexo MT4 platform, which gives you multiple order execution, chart-based trading, and instant response to trading alerts and signals. And you could also use it to build some automatic trading directly into your platform. You build it, so it's unique to you, but it's done with easy steps using the MT4 platform. You also get live signals from Alvexo right on the platform that have 88% accuracy. They're free of charge, and they're pushed out to the platform whenever you're trading. Now, tonight's class is being recorded. To see a recording of tonight's class, just go to www.investing.com where you register for the class, look for the Education tab, and then look underneath for webinars on demand, and you'll find this in about 24 hours from now. Now, Alvexo, since they're a regulated provider, I'm required to give you a risk warning. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all traders. You may lose more than your initial deposit, and you could be required to deposit additional funds. Please ensure you understand the risks and take care to manage your exposure. Now, I see a lot of people who make money consistently by day trading. These are not Johnny-come-lately types jumping into the fad fueled by the bearish tape. They bear no resemblance to all those people you saw in the news just a couple of years ago about secretaries and used car salesmen, dentists, who all showed up on the cover of Forbes and Fortune boasting of their 4-day work weeks. You see all these ads for people sitting on the beach sipping their exotic drinks while they're saying they're getting rich overnight. This is not day traders. Day trading is a job and it's work. So the successful day traders I know have been doing it for years. They all trade through retail brokers that everyone has access to, and some of them even do it with as little as $5,000 in their account. Now, the fact is, day trading is not an investment style or a philosophy. It's a level of financial mastery that most never achieve, but millions desire. Trust me, dig into the deepest, darkest fantasies of even the most hardcore value investor, and you will find someone who wishes they could be a successful day trader. Now, anything that requires focus, drive, discipline, specific skill sets, and yes, even at times a little bit of luck, is hard to do successfully. But because of the vast majority can't do it, doesn't mean it can't be done. Nor does it mean it shouldn't be attempted, as long as you do it the right way. Now, at the end of the day, participating in the market is only about one thing, and only one thing, and that's making money. And you should try to make money in the ways that is not only the easiest, but historically has the highest chance of success. But life is more complex than the markets, and one compelling component of life is the desire to achieve that which will set us apart from the rest. Becoming a successful day trader will bring you rewards that far surpass the majority of market participants. But it is not without risk. It requires hard work and discipline. Day trading can be molded around a person's current life, and this is the nice thing. However, day trading from home is also one of the most capital-intensive arenas. This is because the minimum equity requirement for a stock trader who is designated as a day trader is large, and this amount must be maintained at all times. And that's if you want to trade stock as a day trader. If the trader's account falls below a minimum, he or she will not be permitted to day trade until minimum equity levels is restored, either by depositing cash or securities. Okay, and this used to be the only way that you could day trade. But with the growth of Forex and CFDs, we now have a new way to enter the market with a lot smaller capital, where you don't have to declare yourself a day trader and don't have to put up large amounts of money. So potential traders need to be aware of the other markets that require less capital and have lower barriers to enter. The foreign exchange market, or the Forex market, offers such an alternative. Accounts can be opened for as little as $100, and with leverage, a large amount of capital can be controlled with a very small amount of money. This market is open 24 hours a day during the week and thus provides an alternative to those who cannot trade during regular market hours. Now, we also have contracts for difference. Okay. A CFD market is also expanded. A CFD is an electronic agreement between two parties that involves no ownership of the underlying asset. This allows for gains to be captured for a fraction of the cost of taking ownership of an asset. As with the Forex market, the CFD market provides high leverage, meaning small amounts of capital are needed to enter the market. The stock market can also be traded using a CFD, which means you can trade that same stock. So if you were going to trade Apple and buy the shares, trade it as a day trader through your stockbroker, means you would buy Apple, and I don't even know where Apple's trading, but let's say at $500. They would give a lot smaller leverage because the stock markets have a lot lower leverage, but then you have to pay commissions because they actually have to process the purchase of the stocks, put the stocks in your name and do everything, and it's actually ownership. You could sell the stocks right back, but because of you being designated a day trader and the amount of capital and the small amount of leverage you'll get as a day trader, and the minimum deposit rate, some brokers, if you want to day trade, require you to have a minimum of $50,000 in your account. But you can still trade that same Apple stock at that $500 price as a CFD. But the fact is, in the stock market, you bought and own those certificates. And in the CFD market, you have a contract simply for the difference in the price between where you opened Apple and closed Apple. So if you bought Apple at the stock market for $500, you bought Apple in a CFD at $500, all that's different is the mechanism. If Apple went up to $550 and you closed your position and sold your shares back to your stockbroker, you made $50 per share. If you closed your CFD at $550, you made the same $50 per share. But leverage in the CFD market is a lot higher, so that means you control a lot larger percentage of the market with a smaller capital outlay. And that is what's very important to most of us, because most of us don't have that type of capital to get into day trading in ownership. Okay, so it means you can also trade commodities like gold and oil, copper and silver, coffee and wheat through CFDs. When you open a contract in a futures market of crude oil, the minimum contract is 1,000 barrels of crude oil, which is 50,000 gallons. Well, that's a lot of expense. And even though the futures market has leverage, nowhere near it does in the CFD market. So therefore, high leverage does mean higher risk. But if a trader does not have a large amount of capital, this market can still be entered with very low barriers. Educating oneself on the risks involved in building a strong trading plan are absolute must before partaking in any trading activity. But when you're highly leveraged, it becomes even more paramount. Now, the fact is, to be a successful day trader, you need to trade independently. You also need to capitalize on your capital. You need to understand the different markets that are out there. And most of us should be trading in the CFD market. Now, Some of the prerequisites to day trading aren't that unique to day trading, but are required. Knowledge and experience in the marketplace. Individuals who attempt to day trade without an understanding of market principles will often end up losing their money and going home with their tails between their legs. Sufficient capital. One cannot expect to make money day trading. Day traders use only risk capital, which they can afford to lose. Not only does this protect them from financial ruin, but it also helps eliminate emotion from their trading. A large amount of capital is often necessary to capitalize effectively on intraday price movements. Just imagine, if you're trading a currency through Forex, and a currency, the euro moves a couple pips a day. That's 4 decimal points to the right. Unless you have an awful lot of euros, you're not going to make any money. It's not going to cover your costs. It's not going to cover your spread. It's not going to be worthwhile. I mean, to go out and risk $10,000 to make $100 makes no sense. Okay. Now, if you have $1,000 in your account and you're getting 100-to-1 leverage, means you can control an awful lot of euros for a small amount in your capital. So if you're controlling 100,000 euros and the euro moves half a cent, you made yourself $1,000 or $500. Now, also for day trading, you need to have a strategy. A trader needs an edge over the rest of the market. There are several different strategies that day traders utilize, including swing trading, arbitrage, trading news, among others. These strategies are refined until they produce consistent profits and effectively limit losses. Another key to day trading is a profitable strategy is useless without discipline. Many day traders end up losing a lot of money because they fail to make trades that meet their own criteria. As they say, plan the trade and trade the plan. Success is impossible without discipline. And day trading takes a lot of discipline. You're making trades relatively quickly in a small period of time. So you're having to make quick decisions. And this requires you to follow a plan and a strategy. So after the method of trading that is best fits you has been decided, the next step is crucial. If trading from home is the main interest, then you must decide what markets you will trade based on your capital and your interests. And one more thing, your time availability. If you're not available at the right times of day, there's certain assets you shouldn't trade. First of all, if you're in Europe, in London, and you're sleeping in normal times, you're not going to trade Asian assets. You're not going to trade something on the Hang Seng. You're not going to trade the Chinese yuan because they do all the movement while you're sleeping. Gold tends to have higher movement in the crossover between the Asian and the European markets. So if you're not available in the morning, maybe gold shouldn't be what you trade. So finding the right time and the right days is also important. But you must have a comprehensive trading plan, which is also a business plan, and decides how you will operate as a trader. From there, explore different online brokers and compare what they offer. And you'll find that Avexo offers you an excellent selection of assets, an easy-to-use platform, extensive leverage, and makes it a great place to trade. Once you've selected your broker, then it's just time to start trading. And this is where it comes. It's all about strategy and risk management. Risk management is key in trading day trading. Now, there are certain well-known strategies that day traders employ. These fall under scalping, fading, daily pivot points, and momentum. So scalping is one of the most popular strategies. It involves selling almost immediately after a trade becomes profitable. The price target is whatever the figure translates into that you've made money on the deal. So scalpers make small amounts of money quickly. Fading involves shorting stocks after rapid moves upward, or shorting the euro, shorting gold, shorting Bitcoin. Okay. The other day when Bitcoin sailed to 17,600, okay, to short Bitcoin was a smart move because it just maxed out. It didn't mean it wouldn't go back to 17,600, but after that huge rally, it's going to ease back, and it eased back almost $2,000. Can you imagine how much money you would have made if you shorted Bitcoin at 17.5 and it fell back down to 13 low? You got out of it, say, at 15. You made $2,000 per Bitcoin you own. Well, Bitcoin was at $17,000. So if you had a $5,000 account with leverage, you could have been controlling a lot of Bitcoins. So fading involves shorting stocks or assets after rapid moves upwards. This is based on the assumption that they are overbought. Early buyers are ready to start taking profits. Existing buyers may be scared out. Although risky, this strategy can be extremely rewarding. Then we have daily pivots. This strategy involves profiting from an asset's daily volatility. This is done by attempting to buy at the low of the day and sell at the high of the day. Okay. And then momentum strategy. This strategy involves trading on news releases or finding strong trending moves supported by high volume. So what are perfect examples? What's happening on Wednesday? We're having the Federal Reserve meeting. As soon as they announce a rate increase and the size of the rate increase, you'll probably see gold go up, dollar go up, gold come down, interest rates climb, and a lot of financial markets move after Yellen makes her speech. Okay. This would be an excellent time to trade that momentum at that time. So remember, it's all about strategy and risk management. We're going to keep going over this. So a momentum day strategy. Momentum is what day trading is all about. What you're looking for when you're a day trader is an asset that's moving. If an asset is staying flat or has very little effort involved in movement, momentum to it, it's not worth day trading. So in other words, a day that the euro has no big events, there's nothing going on, the euro is holding at 112, you're not going to make any money. Okay, you need to find assets that are moving. The good news is that almost every single day, there are assets that will move 20 to 30%. So trading new cryptocurrencies is a great, the nicest thing about cryptocurrency, whether it's Bitcoin, Ethereum, they all have volatility and momentum. They're moving up and down all day long. And that gives you ways to make money. The question is, how do we find them before they make big moves? So before going any further, let's step back for a moment and ask ourselves what we require from a momentum trading strategy. First of all, we need, and that is an asset that is moving. Assets that are chopping around sideways are useless. So the first step for a trader is to find ones that are moving. The price action associated with an event is almost always the cleanest. Now you can also use charts and chart patterns, looking at prices and see if they're developing patterns. Because when you see these patterns, like triangles, asymmetrical ascending, descending triangles are great because when you see the price moving into the point of the triangle, telling you that that asset has pent-up demand and it's going to burst out either up or down, we don't know which way, but with a great deal of momentum. So as a pattern-based trader, I look for patterns that support continued momentum. So we can see this pattern using candlesticks. Candlesticks will help us very well define these patterns because we will have a grouping of flags or a grouping of candles that will fill out what's called a bull flag pattern. My entry is the first candle to make a new high after a breakout, so we can scan for assets squeezing up, forming the tail, the tall green candle of the bull flag. Then we wait to see second and third red candles from a pullback. Now, I know most of you probably don't understand how to use Japanese candlesticks, and you need to come to a class in candlesticks and learn all the candlestick formations. You need to learn how to read these on a chart. But investing.com has made it real easy for you. If you go to investing.com and go up under technical and click under candlesticks, you can set up what assets, what type of candlestick patterns you're looking for, what type of trading you want to do, and it'll just alert you when a pattern is developing. So you don't have to go search for them all over. Then when you see that it tells you a pattern's developing, because computers can scan for anything. And when they tell you a pattern's developing in the charts, you can then go look at that particular asset. So when you have a chance, go to investing.com, go up to technical, click under candlestick patterns. You can customize it all, set it all up for yourself, and you'll just see your alerts rolling out there as they're happening. Now, you can then go over to Alvexo and put these on your candlestick charts from Alvexo, because you don't have to go wait for them. You'll look for them. You're just being notified when they happen. Now, remember, it all, though, comes down to risk management. I usually set tight stops just below the first pullback, and you can use your candlestick and your wicks to determine where to put your stop losses and take profits. But the important thing is you want to balance all your risk across trades. The best way to calculate risk is to look at the distance from your entry to where you put your stop loss. Okay, and if I have a 20-cent stop and I want to keep my max risk at $500, I'll take only 2,500 shares. You need to decide what type of leverage you're going to take, how much you're going to invest per trade, and then can you cover the swing of the marketplace? Because before you decide where you're going to put your stop loss, you have to determine where the swing of the market is that day. If you can't cover a strategic low point because it's too far down and would put the loss too high, you can't make that trade. So it's very important to balance your risk. Now, you should always be trading with a minimum of a 3-to-1 win-loss ratio. Okay. Now, some people try to put it higher. Some people try to put it lower. Day traders stay between a 2 and a 3-to-1. Okay. Because you need to have enough profitable trades to offset your losing trades. And you need to be able to balance yourself out. Okay. When you get up to 1-on-1, 2-to-1, you're starting to take more risk than you could reward. It's like going in for a trade saying, I'm willing to lose $500 to make $250. No, I'm willing to risk $250 if I have a possibility of making $500. I personally always use a 3-to-1 ratio, because the other thing it'll do, especially day trading, is it'll keep you out of making a lot of trades. Now, you may want to go back and kick yourself later and say, well, that would have been a profitable trade. I want to be disqualified from too many risky trades. I don't want to have the risk. So when I have reward, it stacks up well because I'm not having to cover 3 bad losers that I lost on. So even though I have a good trade right now that made me a ton of money, I have very little profit. So you always want to look at exits. Exits are very important. How will I exit the market? When will I exit? And how will I take my profit? Okay. Now, for instance, me, when I reach my first target profit, my first profit target, I'll sell half. So half of my investment, take that profit and take my and put it in my account. Okay. Then I've got less risk in the market. When I move to my second indicator, I then sell more, and if you're properly using either trailing stop losses or stop losses, you can still keep moving your stop losses up. So say, for instance, you're trading gold. You entered at 1250. You thought it was going to go to 1275. When it moves up to 1260, I'm going to sell half of it, reduce my investment, take my profit on there, and then move my stop loss up to that 1260. So what happens is, move the profit, my stop loss up to 1250. So even if the asset turns around and goes against me, it's going to close me out at 1250, which is equal to my entry point. So I've only got half my investment still in the market. It closes out at 1250. It means I made no profit, but I had no loss. And I made money on the first half of my trade. Okay. Once I've reached my second indicator, I then move my stop loss all the way up to where it currently is. At this point, if it moves against me, I don't care. Because not only did I sell my first half for profit, I've locked in second half on my profit. Okay. And if I'm lucky and it spikes up again, then I'm doing quite well. Okay. But it's all about strategy. You have to develop your own unique strategy that you can deal with and constantly worry about risk. So one of the simplest and most effective trading strategies in the world is simply trading price action signals from horizontal levels on price charts. If you learn only about one thing, it should be this: look for obvious price action patterns from key horizontal levels in the market. If you just stick to that formula, you will have plenty of high probability trading opportunities over the course of a year. Don't overcomplicate the process by analyzing the market's charts and finding trades. The market will generate signals for you when it's ready. All you need to do is learn what the signals look like and where you would look for them. It doesn't really matter which component you find first, the price action signal or the level. What matters is if the two have come together to form a confluent price action trade. When you have an obvious price action signal, like a pin bar or a fakie signal, and that signal has formed at a key horizontal level of support and resistance in the market, you have a potentially very high probability trade on your hands. Key horizontal levels of support and resistance. Now, we call these key horizontal levels of support and resistance. If you come to my class called support and eyeballing support and resistance, it is simply looking for common prices over a long period that asset's traded at, that you can see that buyers and sellers have always had a problem with that price. They can be used in any market condition, trending, counter trending, trading ranges. The important thing is we are focusing on this lesson is a clear price action signal at a key chart level. These levels tend to act like magnets, attracting price to them before price pushes away again. They can also be thought of value areas or areas on the chart where price found fair value, which typically happens before a strong move occurs again. So we're going to look at a gold chart, and it shows us a nice, clear example of a well-formed pin bar pattern. So you can see it right here on this gold chart. You see we have our key support level, which we did by eyeballing, which we brought historic prices forward, and we found that 1170.75 was a very important level for gold. Where in the past, we had lots of closes and opens, or we had reversals on that. We saw, and this was just an eyeballing. We looked back on the charts to see when assets traded at this price, in this level, what price was important. Now what we do is we see how price reacted at this level. Now we come up here and we see the bulls, the bears, push price below that support level, but it bounced right back up, closed higher, and bounced straight back up. That gives us our pin bar buy level right here at this support, and we would have bought up into that trend. Now, you're not going to learn this in tonight's class, but this is a simple strategy you can use. The next example is for a pin bar buy signal is formed at a key level support in an uptrending market, when you get a price action signal that has confluence with a trend and a level that is a good quality bar. So we can see here, again, the difference is we were already in an uptrend, so it wasn't reversing and moving a new trend. We've established our line of support, and if you don't, like I said, if you don't understand support and resistance, where it comes from, there are many levels you can get support and resistance. You can get it from pivot point charts. You can get them from Fibonacci levels. Okay. There are many ways you can get these key support levels. Once you determine the way you're going to get them and isolate them and put them on your charts. Here we saw price form a new low. We saw the wick fall all the way down here and touch this support level. It wasn't able to violate it, and it bounced back off. So this generated a buy signal. We bounced back in, and we would have bought into this. Now we also got a very specific doji signal in our Japanese candlestick patterns, but you don't have to use candlesticks. You can use a bar chart, and this will give you the same low on the bar chart. Now, in this next chart on the Kiwi dollar, okay, we have a large range trading back and forth between a horizontal level of support and resistance. This is a great way to trade. We've developed a horizontal resistance and support levels, in this case, most likely with eyeballing, and we have the asset bouncing between the two. Moves back up, falls back down, moves back up, falls back down. We see the W pattern developing here, which is really a triple. We have a triple top. Okay. So we have the price hitting the top 3 times. Okay. When it broke through and we see price break that resistance level, but it was only with a wick. It wasn't able to maintain it. It closed below that level. We would have entered this market and traded it going down. So this is how we would use pin bars. And this is just one way that you can day trade. Finally, we can look at counter trend examples of trading price action for day trading. This is the Euro-US dollar chart, and we can see the fakie trading strategy formed at a key resistance level 139.5. The fakie signal showed a rejection and a false breakout. So again, we've got our key level of resistance, okay, and we see the fakie signal. Again, we see this, the wick of the candle, a long shadow coming all the way up here through the resistance, but not able to hold and falling back down. And it told us at this point that we're moving into it was a false breakout because we expected the price to break out and move upward, but the buyers didn't jump in the market. Okay, and therefore, we had a rejection of the resistance breakthrough and moved back into the downtrend. So in conclusion, the main point of this lesson is simply, you do not need a complicated and confusing trading strategy to find high probability entries in the market. All you need is the ability to recognize price action trading trends at key level support and resistance. If you just focus on this one strategy and really master it, you'll be able to look at any charts in any market. But remember, it's all about strategy and risk management. Just because you find a place to enter a trade, an asset to trade, and a place to enter it, doesn't mean you should trade it. You have to calculate your risk, decide where you're going to take your profit, decide where you're going to put your stop losses. Now, another great strategy for day trading is simple moving average crossovers. Moving average indicators are standard with all trading platforms. The indicators can be set to the criteria you prefer. For a simple day trading strategy, we need 3 moving average lines, one set at 20, one set at 60, and one set at 100. These are not days, they're periods. Now, if you're using Forex, which moves faster, we might want to set it at a 10, a 20, and a 30. Okay. Then, when these 3 lines start to cross over, the 20-period line is our fastest moving average in this case. The shorter the period, the faster it responds to current price move. The 60 would be longer, and then 100 would be the slowest. Okay, if we're using a 10, a 20, and a 30, same thing. We're using a 30, 60, and a 90. Okay. Now, when they cross over each other, they tend to tell you something. This day trading strategy generates buy signal from the fast-moving average, which would have been the 20 in that case, crosses up and over the slower-moving average. A sell signal is generated when the fast-moving average crosses below the slow-moving average. So you open a position when the moving average line crosses in one direction, and you close the position when they cross back in the opposite direction. How do you know if the price is beginning to trend? Well, if the price bars stay consistently above or below the 100-period line, and that's why you have the third one in there, then you know a strong price trend is in force and the trade should be left to run. The settings above can be altered to shorter periods that will generate more false signals and maybe more of a hindrance than help. But again, because the Forex market is a lot faster moving market, you need a shorter time frame, where stock market is a slower market, so you need to use wider time frames. The settings I suggest will generate signals that will allow you to follow a trend if one begins without short price fluctuations violating the signal. So on the chart above, I have circled in green 4 separate signals that this moving average crossover system is generated on the Euro-US dollar. Each of those occasions, the system made 600, 200, 200, and 100 points respectively. Well, that's a hell of a trading. Okay. I've also shown in red where this trading technique has generated false signals. These signals where the price is range trading rather than trending are when the signal will most likely turn out to be false. The first false signal is, in the above example, broke even, and the next example lost 35 points. So you made 600, 200, 200, and 100. 6, 8, 10. You made 1,100 points, and you lost 70 points. That's not a bad set of trading. Okay. So it's fairly easy to do. None of these are complex because day trading doesn't give you the luxury of doing all this technical indicators on charts. You need fast, easy strategies that are going to show you price action in the market. So the next chart shows the first positive signal in detail. The first moving average crossed quickly down the slower moving average and then it generated the signal. Notice how the price moved quickly away from the trend. So you can see that right here. So you see the three different moving averages. You have the 100 EMA, the 60 EMA, and the 20 EMA. And you see when they crossed over this way, and then when they crossed back. You got your first signal here, and then you got your second signal here. This would have been your entry and most likely your exit. And you would have made the points between that move. Okay, you probably wouldn't have been able to capitalize on that because that would have taken much more time than your day trading strategy would have allowed. Now, another way is scalping. Scalping, you read about and hear about it all the time, and all newbie traders ask me about two things, hedging and scalping. So what is scalping? Scalping is a trading strategy that attempts to make many profits on small price moves. Scalpers are looking for tiny little moves. Traders who implement this strategy place anywhere from 10 to a couple hundred trades in a single day, in the belief that small moves in the stock market or the Forex market, CFD market, are easier to catch than large ones. Traders who implement the strategy are known as scalpers. Many small profits can be easily compounded into large gains in a strictly exit strategy is used to prevent large losses. Now, you got to remember, even though we're looking to make small moves, you have to cover your costs of trading. So if you think of the average spread as 5 pips, you don't break even unless the asset moves at least 5 pips. So you need 7 pips or 10 pips to make it worth trading. So scalping utilizes larger position sizes for smaller price gains. And that is where leverage comes in. And in the smallest time period of holding time, it's performed intraday. The main goal is to buy or sell a number of shares or assets at the bid or ask price and then to quickly sell them a few points or a few cents higher or lower on a profit. The holding times can vary from seconds to minutes, and in most cases up to several hours. The position is closed before the end of the total market trading session. So when you hear about people, it's not high frequency trading. That's even slightly different. But scalping is very nerve-wracking, but it can be very profitable. Scalping is a fast-paced activity for most nimble traders. It requires precision timing and execution. Scalpers use day trading buying power of 4-to-1 margin to maximize profits with most shares in the shortest amount of time. This requires focusing on small time frames and interval charts. Momentum indicators such as stochastics, moving average convergence and divergence, and relative strength index are commonly used. Price charts such as moving averages, Bollinger Bands, and pivot points are used as reference points for prices. Scalping can account if you're trading, again, we're back to uncap. If you're trading stocks, 25,000. If you're trading CFDs and Forex, nothing. Now, scalpers buy low and sell high, or buy high and sell higher, or short high and cover low. They tend to utilize level 2 and time of sale windows to route orders to the most liquid markets. The point and click style execution through the level 2 windows or pre-programmed hotkeys are the quickest method for the speediest orders. Now, if you're going to scalp, you should be trading on an MT4 platform, which gives you, or a lot of the new online, especially Alvexa, gives you one-click trading. So you can have everything set up and just click. You also have to understand and learn order entry systems. What's the difference between a market order or a limit order? So you can actually set up or pre-set up orders in Alvexa's CFD system so that they're executed at a specific price. Some of the most common mistakes that scalpers make are poor execution. poor strategy and not taking stop losses, over leveraging, and late entries. So these are some of the ways that you can be day traders. Day traders isn't complicated. It's stressful. I'm a swing trader. I like trades to go 30 days. Okay, I want my time. I get my enjoyment out of market analysis. So my reward is ultimately the trade, but not day trading. Day trading can be profitable, but you need, day trading is not, oh, guess what? I don't have a late meeting on Wednesday and the kids are off with the wife, so I can go home and make a couple trades today. That's not day trading. Okay. Now, day trading is every Wednesday I trade, and these are the assets I trade, and this is what I'm looking for in the market, and I do it every Wednesday. It takes a plan. It takes discipline. It is a job. Okay. It could be your second job, but it is a job. But you can make profit day trading if you use some of the easy strategies. Don't get too overcomplicated in the difficult types of trading. Find an easy strategy. Using support and resistance is a great way. Using that with the pin bar method with Japanese candlesticks can also be a great way. But remember, it's all about risk reward ratios and limiting your risk and risk management and money management. And on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. And you can go set up a demo account with Alvexo, www.alvexo.com. And once you do, you could use, in fact, they just launched a whole new academy. You can use all their classes, learn all about support and resistance, learn all about trading strategies in their academy with their live webinars, with their videos, and they're now supplying you signals, market analysis, and all kinds of things. Before you know it, you'll be able to trade successfully. So give Alvexo a try, www.alvexo.com. Good night now. Thank you for joining us.